Hello, I'm Brent Joyce, Chief Investment Strategist for BMO Private Investment Council. We recently published our 2025 Capital Markets Outlook, where we outline our forecasts for the year ahead. Last year, we discussed how 2024 would be a continuing return to normal. We can now say that normal, or more accurately, normal uncertainty, has finally returned. Uncertainty is a constant. We accept it and turn it into a strength, surveying all the possibilities and opportunities that uncertainty provides. We remain constructive on the investment outlook for 2025. Let's start with our views on fixed income. In the past 2 years, with hot inflation and central bank tightening, had conversations about interest rates dominated by how high for how long. Today, the question has shifted. Where will interest rates land and when will we get there? Based on local conditions, the timing and magnitude of rate cuts varies among central banks, but the overall trend is still toward lower rates in 2025. Specifically, we expect the Bank of Canada to lower the overnight rate to 2.5% by June next year and then hold. For the US Fed, we expect them to cut toward 3.5% by the end of 2025. Examining the current level for Canadian and US bond yields, we see room for yields to fall as central banks continue to lower these benchmark rates. This should drive a total return from the broad Canadian fixed income market in the 4% range. Turning to our thoughts on the loonie. The outlook for the Canadian dollar isn't great, but we are more optimistic than many. The different realities for inflation, growth, and interest rates between the US and Canada has kneecapped the loonie. As a country, we're not alone. The US dollar has been strong against just about all other currencies. Now, there aren't many fundamental factors that suggest the loonie's fortunes are going to turn around imminently or even drastically. But given the very pessimistic sentiment, we believe a lot of the bad news is already embedded in the price. We expect the loonie to appreciate mildly with an exchange rate of Canadian $1.35 or US 74 cents at the end of 2025. Lastly, our thoughts on the equity markets. We see the fundamentals of economic growth, corporate earnings, inflation, bond yields, and sentiment as supportive. Valuations are a mild hurdle in some markets, attractive in a few, and we believe with a deft touch, they are manageable in US markets. We see a path to further gains, albeit more modest ones, with the caveat that we could face a growth scare at any time. Globally, there is a powerful alignment of falling inflation, central bank easing, and smooth sailing economies like the US, or economies that are holding up better than feared, Canada, the UK, and a pretty good chunk of Europe, and China is pumping stimulus. Promises of corporate tax cuts are a positive for US stocks. An added plus for US businesses is the expectation of a lighter regulatory touch. This can flow directly to the bottom line through improved profit margins. Additionally, there are strong indications that the US is enjoying a productivity boom. Now, negatives must also be considered. Tariffs, possible trade wars, along with the potential for rising interest rates and inflation caused by government borrowing and spending. We are optimistic that Trump's most egregious tariff proposals are opening salvos to negotiations. Plenty of evidence from Trump 1.0 suggests this could be the case. Canadian businesses should benefit from easier and cheaper financing, a weak currency, a solid US economy, and a reacceleration in global economic activity. Our weak loonie boosts our exporters and inflates repatriated profits from Canadian companies' US operations, of which there are many. Given that the mix of positives outweighs the negatives, we see normal earnings growth as likely, normal being in the high single digits. However, given the positive backdrop, mid to high teens earnings growth wouldn't surprise us. But equity market valuations are above normal in some markets, more reasonable in others. Earnings growth in the teens, even on extended valuations, can deliver high single to low double-digit stock market returns. there is a plausible scenario where above-average earnings growth and continued elevated valuations can deliver another year of exceptional equity market returns. Strings of exceptional equity market returns are not unusual. For the S&P 500, 25 out of the past 96 years have experienced gains of 25% or more. That's a better than 1 in 4 hit rate. Additionally, 2024 is headed for a pretty large gain, but large positive years do not automatically set up for a poor year to follow. There is no discernible relationship across calendar years. The average return after a year of 25% or better stock market return is still 8.6%. All of this has us overweight equities. In our base case scenario, equities can deliver mid-teens total returns. That's including the dividend. Our targets are 28,600 for the S&P TSX Composite and 6,600 for the S&P 500. To wrap it all up, consider the fact that the current bull market for the S&P 500 was born on October 12, 2022. That makes it just over 2 years old. The price only advance to mid-November 2024 is 64%. Since 1949, the average bull market has run more than 5 years and gained 178%. So based off history, things might just be getting started. Thank you for watching. Here's to a great 2025.